economic policy, how it affects your business. And today we've got David, and thank you for joining us, David, along with Thomas Hensley. And they're going to be discussing some of these executive orders and how they will impact your investment strategies. So I'm going to pass it off to Gary to introduce David, but if you have questions throughout the presentation, you know the Q&A feature. If you've been with us before, just submit it. We will likely, if we can answer them in real time, we will, but likely we'll save them for the end. And obviously, let me introduce Exit Advisors. For those of you who do not know our team, we are a specialty M&A group based out of Houston. We focus on private transactions in the $5 to $50 million range across multiple industries. And our goal is to work with you as a business owner, months and years in advance to really maximize the value and do as much cleanup work as possible so that when it's time for you to go to market, you have the most seamless and transparent transaction that can occur with no hiccups, no buyers bailing out at the end. So part of developing this exit strategy, though, is bringing in guys like David and Thomas who kind of take a broader picture. We're going to be focusing on the transaction and the things that encompass the transaction, but there's things beyond that, like your personal wealth, your taxes, things that we've covered before. And today is really going to be focused on kind of the investment strategy and with particular emphasis on the changes that might be occurring with the new administration. So that's all for me. I'm going to pass it over to Gary now.
Thank you. Thank you, Andrew. I'd like to introduce David. I met David. He was a sponsor for Entrepreneurs Organization. And so we got to attend several events and got to know him. I've had the blessing of being able to refer him to some clients who he's done a very good job for. It's interesting. I didn't realize he went to Baylor. My son went to Baylor. My son played on the tennis team at Memorial. And David once played pro tennis. And then he played on the tennis team at Baylor and graduated there with a finance degree. And he's kind of a transplant from Australia. So I'm sure glad he was out of there while the fires were taking place. But we're certainly glad to have him in Houston. And he started with Morgan Stanley, was there for a while in wealth management, and he's moved over now to the private bank of JP Morgan. And one thing that Exit Advisors does try to do is align ourselves with very, very good advisors. And like Andrew was saying, someone who we can literally, after the transaction, hand our clients over to where they're taken care of. And, you hope through that process too, through financial advisors and CPAs and attorneys, once they get to know us better, then they'll be willing to refer business to us as well. And we work together as a collaborative team. And I'm really excited about this presentation. I know that David's going to say something about Tommy and make an introduction there, but I think this is going to be very enlightening. And it's going to give us some insight as to how we should position ourselves during 2021. So David, with that, go for it, man.
Beautiful. Thank you very much, Gary. Appreciate you all having us on. We're excited to talk to you and your group. And, one of the things that I did here was I was speaking with Tommy, one of my teammates, and really thought he would add a lot of value. And so just to quickly introduce Tommy to everybody on the line, Tommy is a Houston resident. Unlike myself, he went to straight Jesuit and then followed through to USC in California. And he started working. So Tommy has a really interesting perspective on things. His career coming from, an MBA at Rice, being an investment associate over at Fayez Sarafim, and then also dealing with distressed debt and investments, and then finishing up at Shell Trading. He really has a very interesting view on what's going on right now. He's also a CFA charter holder, which carries a lot of weight in our business. I think one of the more important designations that anybody could, or more valuable designations that people can carry, and sort of not a easy to get and marketable one. And then sort of Tommy's fun activities, obviously you heard I'm a tennis guy, so my background is tennis. Cooking's another piece of mine, but Tommy he's an avid guitar player. And so if you ever get a chance to talk to Tommy about guitars, you know, I know Tommy would much rather talk about guitars than the projections of oil or whatever political administration is doing. So, you know, I think he'll appreciate any questions on that as well. But, you know, so I'm grateful that, you know, at JP Morgan, we have a deep team, and I have, you know, guys like Tommy that can come in and really show some light for what we're doing. You know, just briefly for everybody that's on the call, we're going to cover where we are right now economically, kind of touch on where we see things going. You know, we will not sell any, you know, products. You know, we're not going to tell you a particular stock that we love. Nothing like that. We're going to talk about, you know, the value of planning, talk about what's going on, and then, you know, how we manage money and things that y'all can consider to use, you know, in your own personal portfolios. And then, you know, at the end, we're going to kind of have a little fun conversation about the, you know, the GameStop trend and sort of what's going on there. But I know Tommy was going to kick us off here with, you know, where we are in the economic cycle.
Thank you so much, David, and thank you all for having me today. So I'm going to take the, you know, theme of the presentation as, you know, what the administration's executive orders may have on your investment portfolio as a subset of, you know, investing in general. And so we will touch upon that, but that encompasses, as David said, where we're going, kind of what our views are at JP Morgan, and then in a more nuanced fashion, what we think the administration, some of the impacts will be on specific sectors. I would say namely larger cap tech companies, and then oil and gas to be the obvious ones, so to speak. So what we say is more important than what we show, and these slides tend to be a little crowded, but I'll walk you through just a handful, and then happy to take questions as well when we're finished here. But, you know, if we look over 2020, it was one of the craziest years we've had on record. And if you would have told me, here's all that information, what do you think the stock market would have done? I would have said we would have seen a lot more volatility, and it would have ended the year down. But that did not happen at all. And global equities finished above 20% for the year. China and India are back where they were pre-COVID right now from an oil demand standpoint. And rates are, you know, at all-time lows. So when we look at where we have been up until this point, the government intervened, and the stimulus put in to combat the pandemic was historical and without precedent. Even in the great financial crisis, which was arguably more of a crisis, we were more on the precipice at that period than we were this year. And it was 5.5 times the amount of stimulus that we saw in the financial crisis. We have another 1.9 trillion of stimulus, you know, going through the House right now. And so all in all, I mean, we're looking at, you know, over $4.5 trillion of stimulus. What's interesting is if we look over the last 27 years, actually now we're in 2021 to be 28 years, we have not seen a meaningful increase in inflation. We really haven't. In my career, in my lifetime, inflation has gone straight down. And we're in a unique period where when we think about the future, because that's what matters and that's what is very important, you know, is inflation dead? You know, what's happening there? And I think if you look, just to reference this slide for a little bit, there, middle of the way through the page, you can see price inflation and wage inflation are showing early cycle. They're both below where the central bank target is, and low in the stable range. So that's somewhere under 2%. The unemployment rate due to the pandemic is also much higher than it was pre-pandemic. So that is not an inflationary aspect at this time. But I will tell you, we cannot print close to $5 trillion in stimulus without any future consequence. So all of these things, these budget deficits that we're running, fiscal policy spending, and, you know, new government spending under the new administration will have impacts, and that would likely increase inflation. To take a sidestep here, the reason that we haven't had inflation over all this time, if you look at technological productivity, central bankers argue this question quite a bit because it's not coming through in the numbers, but it's coming through in asset prices like homes and heavy machinery and cars and things like that. And a lot of that is because we haven't seen wage inflation. Now, there are things that I like, as Dave, gave a little bit of my background. I love music, and that's, my main hobby. And if you look at Spotify, I mean, I would spend probably 5 times the amount on music, rather than just having the $10.81 a month go out of my account every month. So that's just an example of some of the disinflationary forces that we have. But when we look to where we are, we're in an early to mid cycle on both where the economy is going and where where inflation is headed. And if you wouldn't mind just flipping forward to the next slide, I believe it's slide 14 here. So during this time, what's been very interesting is that households have higher savings rates than they've had in years. And the consumer balance sheets are as healthy as they've ever been. If we look at that, a lot of that came through in stimulus checks, and a lot of people have saved money and not spent as mobility has been constrained during COVID. Now, there's a lot of pent-up demand, and we see it in the personal savings rate. We see it in the healthy aspect of consumer balance sheets, and we also see it in the lack of mobility right now. And when you look at mobility as defined kind of by Google's mobility index, meaning literally miles driven and people walking around, spending money and doing things, there is a lot of room to go. And when we get into our forecast, we think that things are going to be much better from an earnings perspective and from an economic growth perspective going forward. What this has done, though, is you have a market right now that looks expensive. I mean, any way you slice it, we're over 20 times earnings on the global markets and a little higher than that in the S&P 500. But a lot of this, I mean, we still have room to grow. And so the main question is the market really ahead of itself, and where are the opportunities given, the change in administration and every other factor around that. So if you don't mind flipping through the next slide. And so global equity valuations, as I just touched upon, are above long-term averages. I mean, we're at 20 times, which is a standard deviation above normal, which is about 16 times. What we have done, given all the stimulus that we have put into the system to combat the pandemic, is and cut rates to zero, is we are forecasting easy monetary policy and fiscal policy indefinitely into the future. So if you look at the S&P right now, 40% of it is made up of tech and healthcare stocks. The top 6-7 largest companies represent 20% of the index, and they are all, heavily tech weighted. When you look at how, to value a long-term business, growth stocks really depend on long-term rates, where those are and where interest rates are. And I will tell you, given, what we discussed earlier, all of that level of stimulus, if you believe that inflation is not going to, go above 1.5% over the next 5 to 10 years, I don't see how that doesn't happen. And those growth stocks will take a hit when you increase the discount rates on, how you ultimately value a business. So I think when you look at that, you should consider, even thinking something like, well, I'm just going to get broad exposure by looking at an S&P index fund. Well, you're putting a lot of money directly into tech stocks and things like that. When we look forward, looking at valuations like this, there are still areas internationally and within the US that look cheaper relative to history. The main, being in Houston, the main thing that sticks out like an eyesore is the energy industry and oil and gas sector. That has been the worst performing sector in the S&P 500 8 of the past 9 years, and it's been all but given up as a lot of the activity early this year on the retail side and the mania has gone to the electric vehicles that were taken public via specialty purpose acquisition companies. And so when you hear rhetoric that oil and gas is dead, that we still somehow demand almost 100 million barrels a day, that typically is a good time to look at that sector. So when you look at an environment that could be inflationary in the future, we think look at emerging markets, looking at markets outside of the United States, and looking at the longer term trends, such as healthcare and sustainability over time as those companies become a more meaningful share of the overall market. And if you don't mind flipping through the next slide. All right, and so to touch upon this and to touch upon where we're going, and to be a little skeptical at first, a healthy level of skepticism. We work at a bank, and if you look across every bank, we will always show that the economy will grow. I mean, that's going to happen. No one is going to predict a recession, because in order to do that, you have to be right, you have to time it right, and you have to know something that everyone else doesn't know, because by the very nature of a recession or market volatility, it's unexpected. Because if it wasn't unexpected, it wouldn't happen. So we think that given where earnings are coming in and given where corporations are forecasting, that we actually see quite a bit of earnings recovery into this year. We think part of that will be the multiple contracting. As you see the long-term interest rates on the 10-year and the 30-year Treasury rise, that may bring the growth stock valuations down, but as earnings grow, that also complements share price and valuation, so to speak. So though things were pummeled early on in 2020, the multiple expanded as interest rates are very low. And now we expect that GDP will grow something like 5.1%, over this next year. And we're more bullish than other banks at they're about 4.5% GDP growth. It is an interesting environment because the market doesn't look very cheap. However, when you think about, what to do, we look at cash rates, and cash is earning nothing. Fixed income looks more expensive than equities on an earnings yield perspective versus the 10-year Treasury and the 30-year Treasury. And we get into an environment where we may see a little bit of inflation. So when you try to look at investing money, and Dave will get into how we view that, but it should be something long-term, not something that's a knee twitch reaction to, any shorter-term policies by an administration or where we are, because you can't time the market with any degree of certainty. And if you were to sell out and strategically try to get back in, you have a capital gains bogey to make up. So not only do you have to be right, at the 28.2% rate, you're going to have to make that up on the way out too. So, so it always, behooves the investor to think long-term. If you don't mind hitting the next slide. All right. And so now to get into some of the administration's policies. I think when you look at large cap tech, the Democrats being in control of Congress and the Senate and Democrat as president, you're going to see more pressure from an antitrust perspective on some of the larger social media sites like Facebook, Google, and the like, and some of the concerns that have been, brought up on, targeted advertising, monopolistic like control over certain markets and things like that. And so those stocks that are already expensive from a growth standpoint do have some risk there from an antitrust viewpoint. I think though the most meaningful area that will be affected from an investment standpoint by the administration would be on the crude oil side, which is coincidentally the cheapest sector out there across pretty much all metrics. So it's our bank view that we're going to be $65 a barrel by the end of 2021, and we're pretty much already there. Personally, I could see risk to oil prices being much higher by the end of the year. And I think when you look at, what you can do, and the executive order that everybody probably has in mind is the cancellation of the Keystone XL pipeline. Well, what's interesting about that is that pipelines are the safest, cleanest, most effective way to transport oil. So what we can do is, politically, you can control the supply side far easier than you can control the demand side. It's easier to cancel pipelines. It's easier to say you can't transport crude from here to here, or to ban drilling on federal lands and things like that. But it's much more difficult to do that on the demand side. You really need to have broad-based, we must have electric cars. We must have these emission standards, and they take a very long period of time to enact and to work their way through. So right now, all of the policies are actually constricting supply and are quite bullish for the price of crude. Because crude can't go to market easily now from Canada down to the Gulf Coast, well, now it's going to go to market somewhere else, and it's going to be more expensive to transport it. And typically it goes by rail. This is using my Shell trading days as reference. It'll go by rail car, or it'll go by truck, which both pollute more. So they consume more energy to get to market, and they're more dangerous from a climate change, from a safety and a climate change perspective, because you're polluting more, it's more costly, and it's you have the danger of oil spills and things like that. So I think what you'll see over the short term are those policies enacted that maybe increase the oil price, which could be some decent news to some of the companies here in Houston. And so when we look at that, and we look at the rest of the policies that the Biden administration has come forth with on an individual income tax rate and capital gains tax side, you may see increases on those rates to maybe the 2 to 5% level. You may also see the estate tax finally sunsetting and splitting in half out in 2024. But the tax plan that he had was kind of dead on arrival, given that the Senate and the House has the narrowest margin of a Democratic majority that we've had in like 100 years. So I think that being said, I think this is kind of the main impact on the investment environment.
Tommy, jumping in here quickly for a quick question on your take on this. So, given that we see crude prices, rise in, established infrastructure becoming more valuable, and established companies sort of having that leg up in this space, do you think that we're going to see? We do know that it's been a challenge for that sector to get new money in, private equity money. It's obviously not the golden child of the investment world. Do you see more liquidity events occurring sort of 2021 and 2022 with this environment, this dynamic, which would directly impact Houston, given that there's a lot of smaller shops here that play in that space?
Absolutely. I would think over probably early 2022. So unlike the times that I worked at Shell Trading, I've had both a front row seat to the financial crisis at a distressed debt investment firm, and now at Shell, seeing oil, kind of tank there. When I joined, it was $100 a barrel, and then it quickly went down to $20 a barrel in a very short order.
So you're bad luck.
What is different between this environment today and back then was that capital markets were open back then to oil companies, and they could borrow, they could issue equity, they could hold production by lease. Now I don't think we have that. We literally have taken off 2 million barrels of supply a day, and we have it's going to be much harder to go get a crew together to get all that money invested and to drill oil and get it out of the ground and go to market. And some of the policies on restricted drilling may impact newer money going to oil companies. So that's absolutely something to consider. But I think any kind of liquidity events are always supported by higher prices and a higher futures curve. And when we get back to a normalized environment where demand in the United States, hopefully by, let's say 3Q 2021, really by 2022, then I think that you'll see, that being supportive and a lot more activity happen around then.
I think that's, extremely helpful information. And it's a really nice insight into sort of some of the foundations that, Tommy and myself use as we start to put together portfolios and the things that we look at as a firm. Tommy said, obviously we're an investment firm. We make money on fees, but, our job is to give the client the clearest and most transparent advice they can get, because at the end of the day, if we're not doing that, then the client's not happy, and at the end of the day, that ends up hurting us. We'll address that question at the end that I saw just pop up. I guess I wanted to touch on a little bit of how we do the financial planning, how we look at staying invested, how we look at the markets. And so if you could jump to the cash slide. And so look, financial planning is not a attractive, sexy piece of the conversation, but at the end of the day, it's the foundation of everything that we do, because we want to make sure that each client knows the purpose for each dollar they have with us. This slide here, it's talking about cash isn't always king. That touches on the pieces that Tommy has been talking about, where, look, we've got zero savings rates in the sense of we're earning nothing on cash. We're losing money basically on a year-to-year basis, and with inflation. And even while inflation is low, it's still more than cash. So, if I came to you and said, hey, are you comfortable losing 2% each year? Most people will look at me and say, Dave, I'm probably not doing that investment. Tying this back into the financial plan, it all comes together because we need to know what our liquidity bucket is. If we don't have a liquidity bucket, then we're investing in certain areas that we might not need to be in. And so, that's why I always pull everything back to financial planning. I'm going to go over a few things, basic finance stuff like compounding, volatility, and staying invested. But the whole purpose is, if we have a financial plan, we can tie each of our decisions back to what the purpose of our dollar is. And so, like Tommy had said, these slides, there's a little bit of noise on there. We're just going to cover, I'm going to walk through how I look at a client's portfolio, their picture, their financial picture. And so the one thing that's really interesting here is, and we forget about it, and you don't realize, but if you started just a basic S&P portfolio in 1970, 50% of the return is coming from capital appreciation, 50% is coming from dividends. And so part of that is respecting the value of compounding. $10,000 in 1970 today would be a $408,000 if you just took out the capital appreciation. If you allowed your dividends to reinvest and compound, you're looking at $1.8 million today. So that's a meaningful difference by staying invested, letting your portfolio work for you. We'll talk a little bit at the end on how we structure portfolios and what pieces go into it. Obviously, everybody's different, so I'm not going to necessarily sit here and say that, hey, look, this is right for everybody, and that's not what I would like anybody to get out of this, other than just taking, look, we have some wide market knowledge that hopefully we've passed along to you, and then things to think about implementing in your own personal situation. There's a thing in financial advisor business, the word called diversification. I've heard it used sort of ad nauseum by advisors. And quite frankly, I think the first thing that we should talk about is over diversification. I think that's happened a lot where people haven't had as much conviction on their ideas, especially after the great financial crisis. The over diversification of a portfolio to soften market movements has really, really occurred. And what ends up happening is, not only do you de-risk your portfolio a lot, but you've also, you're muting your returns. And so you're giving up a lot of returns for this balanced portfolio. And, I'm a big advocate for a balanced portfolio, but that being said, we've seen this kind of trend in our business where it's occurred and there's been too many coins on the table, so to say. And so, I look at diversification as another tool as markets move around and we experience volatility. So, if we've got a properly diversified portfolio and certain subsectors of the market are struggling, but we believe there's a great opportunity there, the diversified portfolio allows us to pull from one place that hasn't been as affected and reinvest in a certain area that we really do have a lot of conviction in. And so those are some little ways that we've used to get extra, alpha or extra returns in a portfolio without taking, without adding on extra risk and overcommitting to a certain space. So I guess that next piece, kind of talking about volatility. So, I like to throw in little numbers on what's happened over the past. So the last 41 years, we've had 23 years of negative 10% returns within the year. So 10% pullbacks or greater within that year. Touching on Tommy's point about timing, 31 of these last 41 years have all turned out to be positive returns. So timing the market and knowing exactly when those pullbacks occur is very difficult, but staying invested is important. And we've kind of, with all this monetary policy, we've kind of grown accustomed to less volatility, and volatility is supposed to be normal in a portfolio. If you tie in a good financial plan that allocates each of your dollars to a certain goal, objective, and this financial plan should be fluid through the whole piece of it. But if you tie that in, you're able to weather the volatility and take advantage of it, as opposed to, if you look at all fund flows and the research that's being done, you see that people generally pull their money out when the market dips and start adding in as the market's at a higher point. Obviously, we'd all love to say we buy high, we buy low and sell high, but if we look at the behavior of the public, that's generally not what happens. And so, having that financial plan that ties in and helps you understand why volatility is normal. If you have an asset class in there that is not behaving, if you have, give you an easy example for everybody. If we had some fixed income that was extremely volatile, then you should be concerned. So, you need to know what each investment you have and how it should behave. If you don't mind jumping to that next slide for me. So I guess before we touch on this particular piece of staying invested, Tommy's talking a little bit about sort of global markets and how, multiples are high, a little higher domestically. We as a general public, and this is globally, tend to invest on a little bit of a bias to our home country. And you'll see it, across the board, US markets, about half of the global market, yet 3/4 of the entire equity market is US owned. Japan, they're 7% of the global index, yet 70% of the Japanese market is owned by the Japanese. So thinking globally, use whatever analogy works. Where if you're at the grocery store, you're not buying the same product from each company. You're spreading that out and making sure you're investing in areas of the market. We mentioned emerging markets being a potential beneficiary over the next few years. Investing outside of just your domestic bias. I think that's really important. Having it all tie into the financial plan helps. So this slide I find really fascinating and really interesting. Over the last 20 years, if you miss the 10 best days, you're annualizing about just over 4% less of a return. I don't know when the 10 worst days are going to, or 10 best days are going to be, or the 20 best or the 30 best, but it's a really interesting slide here. And if we overlay that onto creating a financial plan and knowing, hey, look, these are long-term assets, we're not worried about jumping in and out. As advisors, we're worried about taking the right risk and being invested in the right areas, but we want to stay invested. And so, this is a really interesting piece. You would be negative if you missed the 30 best days over the last 20 years. And 30 days doesn't seem like a lot. We're not sitting here telling you, look, your financial plan is the be all and end all, and you should be invested in the S&P and the MSCI World Index and have a cash bucket. By no means. We're more big advocates on allocating to areas and, adjusting as trends show us. But the key here is staying invested, not trying to time the market, because, if you're waiting for a trade to settle, you may give up, a few percent of annualized returns, which really makes a difference.
Yes. And if I could, impress upon this as well and add to what Dave said, is that this is probably the most important, slide or point that we can make, is that really, if we can prevent clients from, selling at the low, I mean, you can, that ultimately, means more money in the future. And it's really wild. But if you really would have missed the best 10 days in the market, your return is drastically lower, compounded over a 20-year period of time. And it's typical that some of the best percentage return days are within 2 weeks of the worst percentage return days. So it's even more difficult, because that day that you think you can't handle it anymore, you could, the trades could settle and we could be up 5%, and that's gone. And then you have a capital gains bogey if you have gains that you sold that you have to make up on top of the market. So again, timing the market is it's just an impossible task to do reliably over time.
Yeah, so I think there's one or two points that I'd like to make. I know there's a question that we're gonna get to, but the key point here is the financial plan helps you not overweight your cash. Identifying the important things in your life. Hey, I've got to go to Paris for my wife's 50th birthday, and we're taking our friends, or we're buying a new house, or we're buying that holiday house or that boat. Identifying the big cash outlays that come up is important. And then identifying, hey, look, I have a piece of bucket that I want to be tactical with. That's totally okay as well. But making sure that it's not becoming a drag on your overall portfolio is key. The other piece is if we have a good financial plan, which is a fluid document, and I stress that. A lot of people think, okay, I put a financial plan together and that's hard and fast, and I have to save, X amount per month to hit this. Things change over time, and it's okay, but having that in place. But that allows you to kind of the psychological aspect of it, stay invested, understand that this money is maybe money that I'm not touching for 10 years, and it's supposed to be more volatile. It's supposed to move around, because that's how you're going to generate, if anybody ever comes with, hey, look, low risk, high return, it's probably too good to be true. And so, we try and emphasize that, and just time allows you to make better decisions. And so that's the piece that we always try and stress to our clients. At the end of the day, you all made the money. It's your decision, and we're here to give the best advice we can. And, if we can tie that into taking the emotion out of it, then we've seen better results through that. We can talk about maintaining a long run mindset, but at the end of the day, we've seen some of those data points. No rolling 5-year period has had a negative return and things like that. But Tommy, I think it would be, I guess there's one question here, but I was just going to go over how we set up portfolios just as a whole. And I know we both do it slightly different. For the participants here, the way I look at it is take into account what the client makes their money in, where their exposures are, whether they're royalties from oil and gas, or they're got a tech business. So we try and identify their biggest risk that they might not realize that they carry, and try to avoid that with the portfolio. From there, we try and identify cash needs, and then we look at, okay, how do we set up a core portfolio, and then how to be opportunistic with it. Tommy, do you look at things slightly differently when you're setting up portfolios for clients?
No, I mean, that's very good. All those things need to be taken into consideration, and it's always important to have enough cash sitting around, usually like a year to maybe 2 years, that you'll find and don't have to sell if things get volatile in the market. And so I would do everything that Dave said, and look maybe a little opportunistically on the equity side, given what our ideas are and where we think the best place for that is. But it's important to be well diversified, and to maintain that long-term mindset, and to make sure that whatever we're doing is in absolutely the client's best interest all the time. So it depends on the client, obviously, in the situation.
Tommy, can you see that question up there? So kind of going back to climate, taking into account the certainty of future climate change events such as California fires, Gulf hurricanes, polar cap melting, vortex freezes, given recent history.
Oh, yes, that's a good question. So what that would do is already kind of changing natural gas markets, which is really interesting, because if you look at how natural gas trades in some of the other power and energy trades in general, it's based off of a normal distribution of weather going back to the 10 and the 30-year averages. Well, every year on record has been one of the hottest years on record. It was every year until I think a year or two ago. So, the markets are already taking that into account. So that could mean increased energy needs if things are hotter. That can mean more outages as there are hurricanes, things like that. So from a climate change perspective, and to be non-political at all, let's just say the climate is changing. If that's human or not, that question is kind of irrelevant. But given the weather patterns and what we're seeing, the climate's changing. So that does have impacts on, as polar ice caps melt, there could be new trade routes that open. All these fires and things like that all have economic impacts. But I think there's also opportunity, and this kind of gets into, I think, something we were going to touch on at the end. But like electric vehicles is a crazy area of really mania right now. There's no other word for it. And as we are transitioning into a new form of energy environment, fossil fuels will still be a part of that for some time. But there are new areas of investment. And there are many different companies working on it, even oil companies diversifying away from heavy oil, or diversifying away from coal in power generation. And so the economy in general, things tend to grow, and while there could be shorter term or maybe even long term negative impacts that some of the climate change events have on society, there will be technological advancements and things like this over time that will be other areas of opportunity. So it'll just be different. It's a long-winded answer, but it all comes in a cycle, so to speak.
Yeah. I think the one last piece of our presentation that we were going to cover was sort of a little bit of fun on the the GameStop trend, and maybe like quick high level explanation of what happened, and then kind of happy to touch on kind of the areas of the market we're excited about and answer any questions. Tommy, can we jump to that GameStop slide?
Thank you very much for helping with the slides as well. So this is a pretty interesting situation. I want to preface this by saying, if we look at that slide that says if you miss the 30 best days, over 20 years, you're negative 1% return per year. So that ties into the options markets, because options really move on really unexpected jumps. So 90% of options that people buy, puts and calls, expire worthless. So it goes to show you that, tying in this GameStop speculation, that most of the time it's not a good bet. And it's been very popularized on Reddit, Wall Street Bets, and people doing some pretty outrageous things that would make, a banker or financial advisor, it'd make your eyes water, some of the risk people are taking. But this is not a new phenomenon. If we look back in October 26th of 2008, Porsche announced that it had acquired, I have it written down here, 42% of VW when it was one of the most heavily shorted stocks, of Volkswagen. They had another 31% of call options that were in the money. They were planning on exercising to take delivery of those shares. So at that point, people did not know they had such a long position and had to scramble to buy back. And at that point, you buy back at any price, and VW was the most valuable company in the world back then. It beat ExxonMobil, because that was the next most valuable company that was publicly traded at the time. In this situation, it goes on something very similar. This company, GameStop, was in a secular decline, and there were a couple of things hinging on this. The new game consoles, people were speculating that they would be all online to download games, not disc or CDs. That was not the case. Then you had COVID happen, which if you went to Target, you went anywhere, all video games were sold out because people didn't have anything to do. They're all working from home. So it gave them a bump. They also had net cash of $4 a share and no debt, if you look last year. And so it was an odd thing that over 100% of the stock was lent out short. And how that would happen was basically, in a very simple example, Dave, we have 100 shares of GameStop. I want to sell them. So I borrow Dave's shares at 100 shares. And then I go lend out my shares to someone else. So you're double borrowing, so to speak. So you're lending out something that you borrowed from somewhere else. And that gave a dangerous situation from a short squeeze perspective. And so because people, when the stock moves violently up, people have to go cover that and buy those shares back because the cost of borrowing gets prohibitively high. you just run the share price up as much as possible. This is kind of tying into that theme where there's been a lot of specialty purpose acquisition companies coming out that seem to just go up. That's an area that I personally looked at since 2010 because it's been an area kind of like a shady alleyway where people didn't really go, and you could find some real values if you sifted through a lot of bad companies. But they're set up for management teams to make a bit of money because the way that they're structured, there's incentive shares. And so basically you have to acquire a business at like a 10 to 20% discount in order for the investor in a SPAC to break even. And so you have all these electric vehicle companies coming public. And then their company was announced the other day, a battery recycling company that had negative $10 million in EBITDA and is trading at 10 times forecast EBITDA in 2025 of 200 times, or $200 million. So when you start to see things like this, it's showing you the market there's a little frothiness going on. But overall, again, there are still areas that we like, but there are things to watch out for and things to be very cautious about as you hear neighbors and friends talk about this. And when people that don't know anything about markets start making a bit of money, that's when it's time to be, a little more cautious because it's never that easy. So.
Thank you. Is there, I guess at this time we can open it up for any questions.
Guys, thank you a lot for everything. I've got a few things that came across to me personally, and I wanted to go through them. You were talking about volatility and kind of going into the corrections, and there's corrections, recessions, and depressions, and what constitutes each kind of varies. But the ultimate question is, do you have an idea of kind of when and the duration and the magnitude of whatever the next major event's going to be, whether it's a correction or a recession or even a depression? For example, we looked at all-time highs in February of 2021, over 20 or 30% correction, which I think 20% constitutes a recession, but it has to be sustained over X period of time. But then a month later, we were back up to all-time highs again. So I guess my question is, talking about volatility and these major market events, what do you see is happening over the next 12 to 24 months? Are we going to just see a lot of volatility and major corrections down 20 and 30% with a rally shortly thereafter, or are we going to start seeing these cycles more sustained?
Look, I'll throw my quick 2 cents here on this and then let Tommy follow up. But, if we look at it, we're kind of in the shortest bull run market to exist at this point. So we're in the, mid to early stages of a recovery. There is a lot more room to go. But the other thing you got to take into account is there's just so much money getting pumped into our system right now. And while those dynamics exist, we can have that further discussion as to whether we're artificially maintaining the market price. But while those dynamics exist, and future stimulus package coming through, I haven't figured out exactly what the final number is going to be, but it's going to be over $1 trillion by the looks of it. So with that in the market, that's going to help us for at least that 18-month period, like you had mentioned. Tommy.
Yeah, and I think to address that question head on, it's really impossible to know, but I would say it gives you more confidence there should be a correction, just because I don't, things look expensive, but I don't have a reason for why they would go down. If you see inflation peak up in a meaningful way, where you see as the stimulus is wearing off and maybe by late summer things start getting back to normal and it's just not where it's anticipated to go, economic activity doesn't bounce back as hard, that could be opportunity for a correction or to say, hey, things are different. I'd also say when you look at something in a recession or a depression, that's entirely like 95% 5% of the time is credit driven. So I would watch credit spreads. And when you look at companies unable to service their debt, that is when you start to get in trouble. And right now we're just not there. Companies are very easily able to raise debt. And again, when you get sustained inflation over 2%, where the Fed would have to raise rates, they're going to let it run a little bit. They've changed their mandate to say, we'll tolerate inflation, because it's surprised to the downside so many times. So when you start to get that, and then the cost of borrowing increases, and that's when you could see something, you can see it take a turn that way for a longer, more sustained downturn. But in the near term, barring another virus mutation spread around the country, it's just hard to see what would drive it down.
My last point there, and then Jonathan had a question. I'm going to open it up to him. But your point about credit markets is exactly right. And it's typically looking at a short-term, long-term rate inflection. I think, what is it? You really focus on the 2-year, 10-year spread.
Oh yeah, but just the high yield spreads too on corporations, like what those are doing.
And the kind of the rule of thumb is if they do invert, which they have, or they've gotten extremely close, or they're teetering on the line, but they definitely have inverted at points. That once that happens, the kind of standard language, which is never perfect and nothing's predictable, is that within like 18 months, give or take, there will be some sort of correction or recession. I mean, that happened. We went back 20 or 30% from all-time highs. But again, my point is, it corrected a month later. Does that count as a correction when it rallies almost immediately, or do you have to look at something more sustained?
So realistically, as a recession, it's like 2+ consecutive quarters of negative GDP growth. Right. So we had that. I mean, but we had the fastest recession on record from COVID, and it's like the 1915 flu. That's way in the rear view, and the economy is totally different. But I think if you look at that, it's just a very strange time. And to your point, before this happened, the yield converted. So we didn't anticipate there would be a pandemic because it was like a year before. But the yield curve converted a full year before the pandemic happened, almost anticipating some kind of event. And then this came, out of left field, obviously. But it's like 80% or 70% of the time, the yield curve inverts. We've had a recession. We've never had a recession with the yield curve not inverting. So it's not 100% predictive, but it's close. And I mean, if that happens, there's a reason why, people think those longer term rates, because the growth rate's going to get lower. So.
And then I guess the ultimate, which we don't have to answer now, but the question is, since that did happen and we technically entered a recession, but it was not sustained, if you take COVID out of the equation, are we still kind of in the same position where, we don't have a crazy force majeure type event like a pandemic or something terrible, but like, are the markets or the credit markets teetering on the edge of a collapse? But it doesn't sound like it.
Yeah, not right now. It's the level of indebtedness is high because rates are so low. So corporate debt rates are high. That's why I try to focus on inflation a little bit. I know there's a lot to cover, and sometimes I can get lost in some of the side alleys there. But it's so important because because we haven't seen it in 27 years in a meaningful way. I mean, there's been some inflation in the 90s and the early 2000s, but it's not been above that rate where like you've had to sustain rates rising, where we have like 8% mortgages or something like that. And not saying that that's going to happen. It's just, since 2010, especially, inflation's been kind of non-existent. But when that does happen, then your variable short-term rate, gets more expensive. And then companies like, well, this project doesn't make sense, because we can borrow at this rate and that's the cheapest financing. So, right now it's still fine. But again, inflation, unexpected high inflation would be bad, and that could send something to a recession. I think if it's, the Fed's openly communicating, and if things, go smoothly, you could get a slowdown. But I don't think that there's any reason that corporate indebtedness, like there should be a credit market crunch. But again, watching those spreads on a continual basis, the high yield spreads especially, is a good indicator on where we are.
All right, before we run out of time, Jonathan had a question. Jonathan, I unmuted your mic so you can shoot it. And I'm going to add the link that you said as the preface to your question so everyone can see it.
Yeah, sure. Can y'all hear me fine?
Yeah.
All right. Tommy, first of all, good to hear from you.
What's going on?
Tommy was one of the smartest guys. He was a year ahead of me. So definitely, this is actually a surprise. Maybe I didn't do my due diligence. I didn't know he was going to be on here today. I just kind of saw the subject and I thought it was very, apropos, if you will. So, this is a very confusing place for me to be in. And by the way, I'm going to ask some questions. I'm going to do a shameless plug. So the first part is I completely agree. Like, so if you look at the Warren Buffett indicator, we're higher than that, right?
Yep.
But this is largely tech driven. Okay. But your hard asset bases, which I cover a lot, 90%, maybe it's wrong, but like a majority of the wealth in the past has been in real estate. It still is, I think. So we have not seen those prices dip. So one of the sidecar or maybe, long-term things I'm doing is property tax protest. That's going to lead into the same shameless plug. That actually, from my studies at UT, peaks 1 year before any crash, except if it's a tech-driven incident. And I think you hit it dead on with the credit-driven incident, which is where Warren Buffett says, like, no one knows who's not wearing shorts until the water, the tide rolls out. So this is a weird time for me to be able to analyze where to go. Because even like, seriously, my favorite Chinese restaurant I go to, she's giving me stock tips. So that tells me something, but I don't know quite what to do with it yet because the real estate hasn't. But as you can see the article, and I agree with you, the credit is there. And so as long as equities rises, you can borrow off of equity, as I think a lot of these companies have done to bolster their balance sheet. But once it flips, it flips. So we're in a weird paradigm. And the only area that I see value personally is energy. I see a lot of value in energy. I just want to put that out there. Maybe if you want me to give you a little bit more about my thoughts, happy to do so, but that's kind of what was in my mind. And shameless plug here, I do property tax protests. You're going to get taxed every year on any property you do. That's what I do. Doesn't matter, market's up or down, we can get it lower. Anyway, that's it. Thanks. And Tommy would love to hear your thoughts, or whoever wants to address those thoughts.
Oh, sure. Thank you, man. It's good to hear from you too. And thank you for the question and the accolades there. I think about this all the time too, from just a personal standpoint on the stock market. And like the interesting issue, and I have some super sophisticated clients that are ex-hedge fund managers and that trade for a living. And so we get in some pretty good conversations. And again, that's kind of a benefit of, what we have to offer the private bank is we have so many different people. While, our clients are extremely confidential, we have so many different viewpoints that we get across the people in the industry and other industries. And, it helps inform you what's really happening out there. But, I think it's just so difficult right now because, like, again, what Dave, Mr. Galic was saying, if you invest in cash, you just hold it there, you're going to get eaten away by inflation. You're going to lose 1.5% a year. Probably, if that goes up, you'll lose more. Bonds look very expensive. I mean, the earnings yield in the S&P we get the dividends yields like 1.5%. The earnings yield is probably 2.5%, maybe a little more than that. And that's, more than the 10-year treasury. So stocks look cheaper relative to bonds. The amount of stimulus that we put in, we meaning the U.S., government, any governments around the world. I mean, it's 5.5 times the great financial crisis, where we were on the precipice of something really bad happening back in 2008. And I mean, 5.5 times that, it's pretty outrageous. So there is so much money in the system and things being supported. And I think it may get crazier. I think you may see crazier behavior. But we're starting to see some weird stuff with all the SPACs and these values ascribed to things that don't make sense. You get short squeezes, you get, people just, it's pretty much gambling. And so that kind of behavior is reminiscent of the year 2000, and some of the things that, I was at high school at the time, but I heard about some of it, and have studied that area. I don't think anything is going to be that crazy, but it's just too hard to know. Okay, Michael Burry and Jeremy Grantham and others have said a crash is imminent, but you look at their reasoning, it's like, well, because the market's too high, and that's it. Again, it's just level of stimulus, the accommodative nature of the Fed, the fact we don't have inflation right now, the fact that equities look cheaper relative to other asset classes. Like, where do you go? And again, if you look away from tech and you look at energy, you look at some of the cyclical names, if we're going to get inflation, things like that, you look at emerging markets outside the US, then you can be adequately diversified. But you could just sit in cash and lose 2% per year for 2 or 3 more years. And then we get a quick downturn, and, maybe you make it up if you hit it at the right time. It's just very hard to know. And all these indicators and things were made when rates were much higher. And it's just, that's what's going to ultimately matter, is where interest rates go.
Can I give another quick excerpt here? Am I allowed to do that?
Yeah, sure.
Okay, so the other thing that worries me is this is like the second or now might be first highest time, like small investors are driving up the market. You can look at that back in 1999. So you have a lot of retail investors coming in. At the peak of any kind of situation, you see retail investors and institutional investors switching out. I'm just putting that out there to be a background there. So I'm going to kind of like sidestep this and say, if from an investment perspective, and I'm going to ask a question out of this. If I'm looking for a return, I think I'm going to use some proxies like Pfizer that has like a 4% return and say, forget about the price. If I'm going to go bonds, I'd rather go with Pfizer. I don't care what the price is going to do. I'm just going to invest in something like that, get my return. What's your thoughts on that?
Well, not to give any investment advice outright.
Sorry.
No.
Sorry.
But I would say that, and all this is just, our thoughts and where we think things are attractive. But in an environment where things look expensive, high quality balance sheets that are cheaper, that may have higher dividend yields, do look more attractive from a valuation standpoint than long-term bonds, and they're not capped like bonds. But, that kind of weaves into the nature of, this conversation go 800 different ways. But if you look at alternative investments and other ways to diversify outside of stocks and bonds, like looking at some real estate, private investments, there are other ways to do that, but they're not as accessible, let's say, to just an average investor. But overall, I would think those things would do better in a rising rate environment. Anything that has pricing power, any companies that have pricing power, any companies that are related to commodities that, export commodities, let's say like emerging market companies, in anything that's just not valued completely off of growth. Because those are the ones that get hit when the interest rates rise. They get hit the most, I should say. And then there's all these, it's a good question. It's very tough. And I mean, I thought about this 800 different ways, and it's an interesting market, and there are areas of opportunity. And it's, it really just depends on where we go from here.
Thank you, Tommy. You've been brilliant as always.
Oh, thank you so much. I appreciate it.
Yeah, guys, we really appreciate it. And sorry for keeping you for a few extra minutes over the hour, but it was really informative. Really enjoyed the content. Before we close it up or let you have final remarks, I'll remind everyone, keep an eye out. I think in either a second, possibly third, sometime in middle March, we will do another featured event where I think Casey and myself are going to kind of do a panel series with prospective buyers from private equity, family office, and possibly strategic, and kind of interview them on going through due diligence from the buyer's perspective and what sellers need to prepare for. So keep an eye out for that in the next couple of weeks. We'll be getting information out soon. Apart from that, we're done here today. Guys, thank you so much. Any final remarks before we end?
Very grateful for y'all giving us the platform and, allowing us to kind of showcase some of the, intellectual capital that we have. And look forward to talking with y'all again.
Absolutely. Have a good one, guys.
All right, y'all too.
Bye-bye.